If you want to understand why the futures market works the way it does today, you have to go back to a problem farmers had almost 200 years ago. This isn't just a history lesson. The reason futures exist at all, and the reason they're built the way they are, comes directly from this story.
In the early 1800s, farming was a gamble in more ways than one. A farmer would plant corn or wheat in the spring with no idea what price it would sell for once harvest came around months later. If everyone had a great growing season, prices could crash from oversupply. If there was a drought somewhere else, prices could spike. The farmer had no control over any of it and no way to plan. Buyers had the same problem in reverse. A mill that needed grain to keep operating had no guarantee of what it would cost to buy that grain later in the year. Both sides were exposed to the same uncertainty, just from opposite directions. So a solution emerged. Farmers and buyers started making agreements ahead of time, agreeing today on a price for grain that hadn't even been harvested yet. The farmer got certainty on what they'd be paid. The buyer got certainty on what they'd pay. Neither side was gambling anymore. They'd essentially locked in the future.
This practice became formalized in 1848 with the founding of the Chicago Board of Trade, which is widely considered the birthplace of the modern futures exchange. What started as informal handshake deals between farmers and grain buyers turned into standardized, tradable contracts with set quantities, set quality standards, and set delivery dates. That standardization is what allowed the market to grow beyond just the two parties involved in a single harvest. Now, other people could buy and sell these contracts too, even if they had no interest in ever actually owning the grain. Over the following century, this same concept, locking in a price now for something that happens later, got applied to more and more things. Precious metals started trading as futures. So did energy products like crude oil. Eventually, the concept expanded into financial instruments entirely disconnected from physical goods: currencies, interest rates, and stock market indices.
That last shift is a big one. When stock index futures were introduced, it meant you could trade on the future direction of an entire market, hundreds of companies bundled into one number through a single contract. This is where products like S&P 500 futures and NASDAQ 100 futures come from, and it's a huge part of why the futures market today looks nothing like a bunch of farmers negotiating grain prices, even though the underlying mechanism is identical.
What's remarkable is how little the core idea has actually changed. Whether it's an 1800s farmer locking in a corn price or a trader today locking in exposure to the NASDAQ 100, the purpose is the same. Agree on a price now for something that happens later to manage uncertainty about the future. Understanding this history matters because it explains why futures markets are built the way they are. Standardized contracts, expiration dates, margin requirements. None of it is arbitrary. It all traces back to solving a very old, very practical problem. In the next video, we're going to look at how futures actually stack up against stocks. Because if you've only ever traded or thought about stocks before, the differences are bigger than most people expect. Subscribe if you want to keep building this foundation with me, one piece at a time.